In December 2025, BlackRock, the world's largest asset manager with over $10 trillion in assets, quietly updated the prospectus for its iShares Silver Trust, SLV, the second largest precious metals ETF in the world. Buried in the legal language was a startling admission. The trust may encounter difficulty in acquiring sufficient physical silver to support creation of new shares. This wasn't a routine disclaimer. It was a seismic signal from the heart of the financial system. For over 18 years, SLV operated under the assumption that physical silver was always available for purchase on the open market. Investors bought shares believing they were backed one-to-one by real metal stored in vaults in London and New York. But now, the world's most powerful financial institution is saying, that assumption may no longer hold true. In early 2026, with silver trading above $90 per ounce and global demand surging from solar panels, electric vehicles, and central banks, the physical market is tightening faster than anyone predicted. And if BlackRock, the entity that can move markets with a single trade, can't reliably source silver, what does that mean for ordinary investors, industrial users, and the very idea of a liquid commodity market? By the end of this video, you'll understand exactly why BlackRock issued this warning, what it reveals about the hidden fragility of the silver supply chain, how this affects your investments and your cost of living, and why this moment could mark the beginning of a fundamental shift in how we think about ownership, scarcity, and value in the 21st century. To grasp the significance of this prospectus change, we must first understand how SLV actually works. Launched in 2006, the iShares Silver Trust was designed to give everyday investors easy exposure to silver prices without the hassle of buying, storing, or insuring physical metal. When you buy a share of SLV, you're not buying silver directly. You're buying a share in a trust that holds physical silver bars in secure vaults. The mechanism is simple. Authorized participants, large banks like JP Morgan or HSBC, deliver physical silver to the trust's custodian, receive new SLV shares in return, and then sell those shares on the open market. Conversely, if demand falls, they redeem shares for physical metal. This creation/redemption process is supposed to keep the share price closely aligned with the spot price of silver. For years, it worked smoothly. But the system relies on one critical assumption. Physical silver is always available for delivery in the required quantities and purity. That assumption is now breaking down. The warning in BlackRock's 2025 prospectus didn't come out of nowhere. It was the culmination of three converging trends that have strained the physical silver market to its limits. First, industrial demand has exploded. Silver is no longer just a monetary metal. It's an essential industrial input. A single utility-scale solar farm uses over 5 million ounces of silver in its photovoltaic cells. An electric vehicle contains 25 to 50 grams in its power electronics. Advanced semiconductors rely on silver for thermal management. According to the Silver Institute, industrial consumption hit a record 620 million ounces in 2025, up from 480 million in 2020. This isn't speculative demand. It's real, growing, and non-discretionary. You can't easily substitute copper or aluminum in high-efficiency solar cells without sacrificing performance. Second, mine supply is stagnating. Global production peaked at 880 million ounces in 2024 and is now declining due to water shortages in Peru and Mexico, aging mines in Australia, and permitting delays in new projects. Recycling, once a key buffer, has plateaued at 180 million ounces, as recovery rates from electronics remain below 20%. The result? A structural deficit of over 150 million ounces in 2025, covered only by drawing down exchange inventories. Third, monetary demand has surged. Central banks, led by China, Russia, and Turkey, have quietly added over 100 million ounces to their reserves since 2022. Retail investors in the US, Germany, and India have pushed coin and bar sales to record highs, over 300 million ounces annually. Unlike paper claims, this metal is leaving the system permanently, going into private vaults or sovereign stockpiles. Together, these forces have created a physical shortage beneath a liquid paper market. On COMEX, billions of dollars in silver futures trade daily, but the actual metal backing those contracts is vanishing. As of January 2026, COMEX registered inventories stand at just 26 million ounces, the lowest since 2018 and equivalent to less than 3 months of industrial demand. London good delivery bar holdings outside China are at a 12-year low. When BlackRock or another authorized participant tries to create new SLV shares, they must source thousands of 1,000-ounce bars of 0.999 fine silver. But refiners are backlogged. Miners are selling directly to industrial users under long-term contracts, and central banks are hoarding. The metal simply isn't available in the open market at scale. This is what BlackRock's warning really means. The paper silver market is decoupling from physical reality. For ordinary investors, the implications are profound. If you own SLV shares, you may believe you have exposure to physical silver. But if the trust can't acquire new metal, 2 risks emerge. First, the share price could deviate significantly from the spot price. In a redemption scenario, if there's not enough metal to fulfill requests, the trust might suspend redemptions, as the Sprott Physical Silver Trust did briefly in 2021. Second, counterparty risk increases. Your investment depends not just on silver's price, but on BlackRock's ability to manage a shrinking physical pool. This isn't a criticism of BlackRock, it's a reflection of systemic scarcity. The same dynamic applies to other precious metals ETFs, but silver is uniquely vulnerable because of its dual role as both a store of value and an industrial commodity. Gold can be held indefinitely, silver gets consumed. But the bigger picture goes beyond investing. The BlackRock warning is a canary in the coal mine for the entire clean energy transition. Solar panel manufacturers are already facing delays in securing silver paste. EV makers are redesigning inverters to use less silver, but these changes take years and reduce efficiency. If physical silver becomes scarce or prohibitively expensive, the cost of decarbonization rises dramatically. A 2025 study by Wood Mackenzie found that a sustained $100 silver price would add $90 to $130 to the cost of a standard solar panel, pushing payback periods beyond 10 years in many markets. For developing nations trying to build renewable capacity, this could delay energy access for millions. The irony is stark. The metal enabling the green revolution is becoming a bottleneck to its success. Moreover, this scarcity is accelerating de-dollarization and resource nationalism. Countries with silver reserves are recognizing their strategic value. Mexico, the world's largest producer, has begun restricting exports of unrefined ore. Chile is prioritizing domestic refining to capture more value. China, which refines 60% of global supply, is using silver as collateral in BRICS plus trade settlements. The era of freely traded, fungible commodities is ending. In its place is a world of strategic stockpiling, bilateral deals, and national control. BlackRock's difficulty in sourcing silver isn't just a logistical problem. It's a symptom of a fragmented global order where resources are weapons, not just inputs. So what should you do? First, understand the difference between paper claims and physical ownership. If you want true exposure to silver, consider taking delivery of coins or bars, stored securely outside the banking system. This eliminates counterparty risk, though it adds storage and insurance costs. Second, diversify within the precious metal space. Gold remains a pure monetary asset with deeper liquidity. Platinum and palladium serve different industrial roles. Third, recognize that scarcity creates opportunity. Companies developing silver recycling technologies or alternative metallization for solar cells, like copper plating, may offer indirect exposure to the trend. But avoid speculation. This is a structural shift, not a short-term trade. Critically, BlackRock's warning isn't a prediction of doom. It's a call for realism. The financial system was built on the assumption of infinite substitutability and frictionless markets. But the physical world has limits. Water, energy, minerals, these are finite. And when demand outstrips supply, no amount of financial engineering can create more atoms. The SLV prospectus update is a rare moment of honesty from the heart of Wall Street. The real economy is reasserting itself. This isn't just about silver. It's about the end of an era where finance could ignore physics. In the 20th century, we believed markets could solve everything. In the 21st, We're learning that some things can't be printed, digitized, or securitized. They must be mined, refined, and conserved. Silver is just the first test case. As we move deeper into 2026, watch not just the price of silver, but the premiums on physical bars, the inventory levels at COMEX, and the redemption activity in SLV. These are the real signals of stress. The paper market can lie. The physical market cannot. BlackRock didn't issue this warning to scare investors. It issued it because it had to, because the rules of the game have changed. And if the world's largest asset manager is sounding the alarm, it's time we all paid attention. If you want clear, fact-based analysis of how resource scarcity, finance, and geopolitics intersect, without hype, fear, or oversimplification, subscribe to U.S. Silver Market. We track the real flows behind the headlines, because in an age of hidden shortages, understanding physical reality is your strongest asset.